from an energy point of view, you just have to stand today's ratio on its head. So instead of spending 2/3 of global capex on oil and gas and 1/3 on clean, we should be doing it the other way around. We should be doing 2/3 on clean and 1/3 on oil and gas as we go through the transition. And I think that, as I say, is an encouragingly simple thought.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Welcome to Energy Unplugged. I'm John Feddersen, co-founder and chief executive of Aurora. And on the show today, I'll be speaking with one of the city's top utilities equities research analysts. My guest on the show today is Sam Arie, research analyst at UBS. Welcome, Sam.
Hi, John. It's a pleasure to be with you.
Now, Sam's background is essentially it's a sort of meandering path from sort of blue chip organization to blue chip organization. When you look at it, he did a degree in classics at Oxford, and then stints at the London School of Economics and Harvard. Started his career at the World Bank, and then had a long and distinguished career at the Boston Consulting Group, becoming a partner. Since then, he moved to UBS, the investment bank, where he leads their utilities equities analysis team. He also had detours during his career at one point to Oxford Smith School for the Environment, where he looked at UK energy policy, and also to an energy services startup. Sam, question on the background I have. When you were doing research at Oxford, I read an article you wrote in The Guardian around what was known as the Green Deal. At the time, it was around lending money to households for energy efficiency improvements. You said it wouldn't work, and I think most people looking back now would say it didn't work. Why is it so hard to get home energy efficiency working well in the UK or more broadly?
Oh, well, that's a great place to start this conversation. And it's a topic I spent some time on. Well, that's sort of best part of 10 years ago. And of course, it's a good topic. Energy efficiency is important, and we need to be developing energy efficiency in sort of all walks of life. But there are two problems with it. One is energy efficiency tends not to save you much energy. It's something that the Victorians were the first to notice, but the more efficient you get in your use of a fuel, the more useful that fuel is to you, and you tend to end up using more units of it. So I'm always a bit doubtful about energy efficiency as a goal anyway in energy policy. But in residential housing, which you were asking about and which I worked on a little bit 10 years ago at the Smith School, it's also just very difficult because the things you can do which help with efficiency are all quite expensive and quite long payback. You know, replacing single paned windows with double glazed windows can have a 50-year payback, depending how much you spend on the windows. And it's well known that people tend to live in the same house on average for about 10 years. And so a 50-year payback is too long and too slow. But there are a number of issues like that. Those are the kind of problems that you have in residential energy efficiency.
Interesting. I mean, I often hear politicians, policymakers say, the cheapest low carbon electron is the one you don't use. But I suppose by definition, it's free. You're challenging that logic. In fact, you're suggesting that to decarbonize, it's much better just to produce lots of cheap electrons and cheap low carbon molecules, and you're going to get more bang for your buck that way.
Yeah, well,
right?
Look, don't get me wrong. We have to reduce wastage, especially in the sectors that are running off fossil fuels. Of course, we need to do that. But just look at the last 50 years. What's happened to global primary energy demand is pretty much tripled, quadrupled in some areas. And what's happened to efficiency? We've got more efficiency and more efficient in almost every walk of life. So the proof is in the pudding. The more efficient we get, the more we use in absolute terms. And of course, nature doesn't care about efficiency. nature cares about the total amount of carbon that's going into the atmosphere. So if our goal is decarbonisation, I think we have to be a bit careful about expectations for efficiency.
Yeah, and I suspect there's a nuance there. How much of that energy efficiency was policy driven, and how much of it was economics? Of course, the private sector likes to economize on things in general. I suspect. Good. So you're now at UBS doing equities analysis. Could you just briefly explain what the role of an equities analyst looks like for the broad audience that is our listener base?
Yeah, so I am an analyst for a bank, for UBS, and I run the European utilities team. So my job is to provide analysis and valuation of the listed shares in the European large cap utility space. Our clients are asset managers, so hedge funds and pension funds and so on, portfolio managers and their analysts, and they might look to us to have a discussion about a stock they're interested in buying or selling, and to understand what our view is on how much that particular stock is worth, and of course the reasons why we think that.
Mm-hmm.
So that's our job.
And what was it like moving from consult? You're a partner at BCG, one of the world's most famous consultancies, to equities analysis. What was the move like? Why did you do it?
So, yeah, that's a good question. Probably mainly for my own reasons. I spent a good old time at Boston Consulting. I enjoyed it. I think the work's very interesting. I learned a lot there, and I made some lifelong friends, clients and colleagues. So I feel very positive about my time at BCG. But I think at a certain point in my career, I just thought the analyst role might be a better fit for me. There's a bit more exposure as an analyst in that, you get to publish your views to a wide audience and to make your calls. Of course, it can be very obvious if you're wrong about something, but there's also a bit more chance to spend your time on the big topics and think about essentially where you think the world is going next and why. And that's the part I was attracted to in being an analyst, and the part I enjoy most about the job.
Do you? I in full disclosure, I had a far less illustrious career at BCG, and also loved it, and then moved on. Do you have an impact? Do you think equities analysts have an impact on markets? Do you see your research moving markets in real time when you produce it? You say something good about someone and their stock goes up one day.
Yeah, so that's a good question, and to be honest, I think the answer is yes and no. So if you, as an analyst, if you figure something out that's going to happen and the markets haven't spotted it yet, then yes, when you publish that, the markets ought to react, and they often do. Not always straight away, but over time. And it's a good feeling when that happens. But the markets don't move just because some analyst somewhere has written some words down on a piece of paper or calculated some number in a spreadsheet. It's not the analyst which moves the market. It's the thing the analyst has figured out which moves the market. And so that's the fun part, because the job is to figure out what is that thing.
Yeah. So there's and it sounds like, so there's this theory in finance that many will be familiar with, the efficient markets hypothesis, that says that something along the lines of all available information is automatically incorporated into stock prices. It sounds like you're not a supporter of the efficient markets hypothesis. You think that with effort and analysis you can find a bit more information and truth.
Well, I wouldn't say that that I don't support that hypothesis. That's maybe you should ask a finance professor on that one. But I would say if the efficient markets hypothesis is right, the way it happens is by people doing analysis and figuring things out. So I just think that as analysts, we're part of that process.
Yeah. And how much of success in your role, and this is something I think about a lot in the context of Aurora, because of course we do quite a lot of forecasting as well, fortunately long-term forecasting rather than short-term forecasting, but how much of success is luck and how much of it is skill in your role, do you think?
So you warned me about that question, and I wrote in my notes, "I have no idea!" Exclamation mark. I think probably to be a bit more thoughtful than that. I think there is a roll of the dice in most walks of life, and that's true for me as an analyst, and for you as a price forecaster, and for many people in many jobs. But there are things you can do to kind of tilt the probabilities. And I would say one thing, that the very nice thing about being an analyst is that, we're talking every day to the market, to clients, to, our colleagues, the energy analysts around the world in other regions, the analysts of other sectors, and of course to the companies that we cover. We go on roadshow with them, and we do events with them, and we're often on the phone to them. And literally everybody you talk to has some knowledge that you don't have. It can all be, of course, public information, and we operate only in a world of public information, but you can still be learning every day from talking to people and debating the issues. And of course, sometimes it's overwhelming because you're drowning in information, and the job is to decide what you're going to ignore. But sometimes it's quite exciting because you realize you're at the center of a debate, and you're the one who's going to be able to put the pieces of the puzzle together before anyone else does.
Yeah, one thing I think there's something about people's expectations as well. Do you get and I imagine you're dealing with a fairly educated audience, but do you? When I liken it a little bit to coaching forecasting a bit like coaching a football team. You probably get too much credit when you're winning and too much credit when you're losing as well, in a sense. Do you find that a key element of this is kind of setting the bar at the right level? Like if there are people who understand that what you're doing is complicated, then you're going to be wrong. If you're doing it well, you're going to be wrong 49% of the time or something like that. That's an easier interaction than those out there that are don't know where to set the bar, but that both exist.
Yeah, I think I hadn't thought of it as setting the bar. I think of it probably in real life more as getting through the day. But I think you're probably right that if you set out as an analyst to anticipate and evaluate everything, correctly and first, you would never be able to do that. I think if I put myself in the shoes of some important clients of ours, they don't expect us to know everything. They know that they know a lot of things we don't know. Our role is to, contribute. And sometimes you contribute by just providing some information. You might have been to a results call that the client didn't listen to, and you're just feeding back what you learned. You might have been on roadshow with the company, or you might have had an idea, or you might have been reworking the model and realized that something doesn't add up, and you changed your forecasts. As long as you've contributed, I think clients appreciate the work, and no one expects us, any individual analyst, to have mastered everything. I mean, thank goodness, otherwise it would be an impossible job.
Do you think you raise an interesting point there on changing one's mind? I think in the political debate, at least, I think there's a pretty high tax you pay for changing your mind in general. Do you think in equities analysis the price is higher than it should be for changing one's mind on things?
So there's a trade-off there, I would say, because on the one hand, I would say I change my mind all the time. We've had stocks we upgraded and then we downgraded, or downgraded and then we upgraded. When the facts change, you have to change your point of view. Or even if you realize that you interpreted the wrong facts, or you put too much weight on one fact and another fact turned out to be more important. So you do need to be able to change your mind frequently, and be thick-skinned about it and explain why. On the other hand, our kind of views are published. There's a process for publishing. We only ever publish to everybody at the same time. So, and that process takes a bit of time. So we don't change our ratings every day. We change ratings maybe half a dozen or a dozen times in a year. And we're not like, a fast-moving hedge fund that might be changing their positions, a dozen times in a day.
Yeah.
You know?
Yeah.
So we're somewhere in between.
Okay. Could I ask? So I imagine that one of the biggest topics for you this year has been COVID-19. Although I know you've been researching on a bunch of other topics as well, and managing to move beyond COVID as well. How can you say a bit about how you see that? It hitting the utility sector, and which regions in Europe is it hitting? Which types of companies is it hitting in general?
Well, look, it hit everybody to begin with, across markets and within the sector, across across the value chain and across geographies. I think the main problem at the end of March was just trying to get a handle on what COVID would mean. So what was it? What would the policy response be? And who would have exposure? I think from the company's point of view, they had to react very quickly just to, number one, look after their people, and, number two, kind of keep operations running. And so they had their heads down doing that for a bit before they started communicating to the market about earnings and valuation and so on. But as we started to figure out what the valuation impacts were going to be, I would say it was quite widely spread across the value chain. There were impacts in upstream for those with oil and gas business. That's relatively rare in utilities now, but there's still a bit of it out there. There were impacts in downstream for those with a services business and sort of feet on the street that were impacted by the lockdowns around Europe. I think all the power generators felt the impact of a big step down in power demand, and then prices moving with it. And then the other thing in Europe is we've got a bunch of companies that have a footprint in Latin America. And so then you started having exchange rates moving quite dramatically as well. So I think almost all of the names had some exposure. There were a few which where we thought the exposure was much less than others that were more resilient. But even those that had quite a big knock in the end of March, beginning of April, have bounced back quite strongly already in May and June, which tells you something about where market sentiment has gone.
Yeah, and do you see the impact in the long run? So you talked about demand shocks and exchange rates and those types of things, and I suppose there's a couple possibly, and one is we've seen BP revise down their oil price assumption substantially. Sort of on the basis of COVID, they've changed their view on what the 2030 or the 2035 oil price looks like. There's also, I suppose, with some for those that have regulated returns, more stable. Arguably, that those assets are seen as having a bit more of a premium compared to those that are more merchant and more exposed to these types of risk. Perhaps it's made them more salient. Where have you seen the big long run? Has anyone changed their long run view of the world?
Well, I think we're all kind of in the process of adjusting our worldview. But your BP example is interesting, and I'm not the analyst on BP, so I should be careful to say I'm not close to what BP's thinking is. But I would guess from the outside that their long-term oil price forecast changes have as much to do with climate change as they do as they have to do with COVID. Yeah. And that would be kind of my answer to your question as well. And what I mean is that I would say, yes, COVID is evidently going to have some important impacts on all of our lives, on small things like, working from home and not commuting, to big things like bond yields and the national debt and what you think happens to international relations and geopolitics and the US and China and so on. But my personal belief is that there will be even more important, significant impacts for humanity as a whole from climate change. Mm-hmm. Although we need to be focused on COVID this year and for a period of time, I think we'll pretty soon be refocusing again on the challenges of climate change and energy transition. And if John, if you're thinking, I suppose lots of us do, if you're thinking about how our children's lives might be different to our lives, I would think that climate change is likely to have the most important impact on that kind of question in the long run.
Yeah, okay. So, okay, interesting. And I suppose COVID Do you think it's made the risks of climate change more salient, or do you think these are sort of unrelated risks?
Well, I mean, there are overlaps in a lot of these topics, and they have to do with the interconnectedness of the modern world. But actually, I would say in the short run, what was interesting is that the need to focus, and rightly focus, on COVID absorbed all the attention of companies and markets for the last few months. And I mean, it seemed like an eon away, but in December, January, February this year, I would say 99% of conversations we were having had a energy transition or climate change type component to them. That was the main topic that anybody in the energy sector wanted to talk to us about. Of course, from March, April, and May, 0% of our conversations were about the energy transition. And through June, I would say it's gone a bit more 50-50. The immediate pressures of COVID have eased a little bit, and then some of the climate topics have edged their way back into the news and into people's minds.
Yeah.
And I think that process will continue.
Yeah, good. And that's probably a good segue to some of the themes that you've been thinking about and publishing on around the energy transition. So for those that don't follow Sam's work, he publishes these big picture topics. A couple of years ago, it was about the big renewables potential globally, hundreds of gigawatts per annum. I think last year you were focused on where capital was coming from for the energy transition. And I found that a really interesting topic. You were talking about how a lot of the capital will come from oil and gas majors, the BPs, the Shells, in order to drive decarbonisation of the power sector and more broadly. What is it that gives you confidence that these big oil and gas companies, where 95% of the revenues is coming from carbon intensive activities, what gives you confidence that they can play such an important role in the energy transition?
Well, right. So this is the meat of it then. So now we're really into some content and some thoughts about the world. So I love having this discussion, and your question's well put. And I think you are right to focus on where the money is going to come from, which is what you're doing and what we've been trying to do as well. And one place clearly that financing the energy transition, finance for the energy transition could come from is the oil sector. And actually that's kind of an encouraging point, because if you look at the data that's available on global investment, capital spending in the energy sector around the world, in recent years, what you see is a mix that's about 2/3 of the total on fossil assets and projects, and about 1/3 on clean energy activities. And if I go back, John, to that fantastic report which your team wrote for us last year, you guys made an estimate of how much we need to spend on the clean side to get to net zero, and you put the number at around a little bit over $1 trillion a year. I think it was 1.1, 1.2 for the next 30 years to get to net zero 2050. And then that in turn turns out to be the equivalent of about 2/3 of the current global capital spend in energy. So what I'm saying is, look, from an energy point of view, you just have to stand today's ratio on its head. So instead of spending 2/3 of global capex on oil and gas and 1/3 on clean, we should be doing it the other way around. We should be doing 2/3 on clean and 1/3 on oil and gas as we go through the transition. And I think that, as I say, is an encouragingly simple thought, but it does kind of mean that does that mean that I'm confident the oil majors are going to carry out that sort of rotation for us? And I'm not sure. Some of them talk about it and look pretty motivated already, particularly in Europe. Some of the US majors look a bit less motivated, to be honest. But in a way, I'm tempted to say, look, it doesn't matter what management teams think, because at the fundamental level, this is a global capital allocation problem. And that is what capital markets are there to sort out. Yeah. And I'm the first to admit that there's a lot of things wrong with capitalism. If you want to come back next week and we'll do a podcast on
The problems with
how to
capitalism.
fix capitalism, then please count me in. I have a lot of thoughts on that topic too. But capitalism is the system that we've got right now. And my view is that the way capitalism will try to solve the climate problem is actually much more simple than everybody thinks. And it's essentially the cost of capital. So debt and equity will become increasingly expensive for the fossil sector and increasingly cheap for the clean sector, at least on a relative basis, until that tips the scales enough for the capex to flow from one sector to the other. And governments will try and help that process, and some are trying already, but eventually management teams will have no choice. They just have to follow the money.
Yeah, is there something on oil and gas? So, I suppose if they need to go from 2/3 to 1/3, they're halving their capex. They're going to generate lots of cash. Is there an argument that they're better off just paying dividends to shareholders, not even trying to get into this renewable space, or do you think it's or whatever it is, energy transition space, or do you think it's a natural adjacency?
Yeah. Okay. So let's let the thousand flowers bloom. The oil sector is a big sector, and let's let some different companies take different approaches to it.
Yeah.
I mean, to be completely, to draw a cartoon of what we see at the minute, it feels like the US majors are more in the camp of sticking to your knitting and paying out dividends and buybacks and so on. It means that money will end up back with investors, and then maybe they'll invest it back in my sector. So the rotation will happen that way.
Yeah.
European oil companies are a bit more in the mindset, it seems, of rebalancing their capital plans themselves. And of course, the advantage of the US approach is you don't have to change much in your organization. But the disadvantage after a period is you've got to manage a declining business, which is always hard in oil and gas, as in consulting or any other business. On the other hand, for the Europeans, the advantage is they have these big visions and they can talk to their employees and their stakeholders about where they're trying to go, which is great.
Yeah.
But they have a lot of change to deliver, which sometimes works and sometimes doesn't. So as I say, let's let the thousand flowers bloom and see which strategy grows the best.
Yeah, and I'll try and we might briefly talk about because your big recent topic is about hydrogen and when or if that's already reached parity with oil. To me, it feels like, and we'll get into this hopefully a little bit later, that hydrogen and a global market and transport could be the thing that these major oil companies have a natural advantage in the zero carbon world. So that potentially could be a game changer, it feels like to me. The other topic of your major research has been around, or at least you've been talking about, the phenomena of global utilities. The argument there's going to be hundreds of gigawatts. Aurora is 1.1 trillion per year or whatever it is. And so if you're a European utility like Ørsted or RWE or Iberdrola or EDP or whoever it is, you should be chasing global opportunities. Is that what's driven this change from kind of vertically integrated national champions to global multi-market renewables developers and operators, or is there something else going on here?
Yeah, what I think is going on is actually pretty straightforward. I think it's old-fashioned economics, and it's you'll laugh, but it's the old Boston Consulting Group industry learning curve at work. I think historically a lot of utility businesses were local because they were regulated, and regulated businesses do well when they're close to their regulatory stakeholders, look after the authorizing environment, the media, the NGOs, the politicians, the technical regulators who determine which activities you're allowed to undertake and how much money you can make. And that tends to be a local activity. In renewables, this is an industry that's been growing up on subsidies originally, and now what's left of subsidies or regulatory frameworks, which you still have to bid to get access to. And so everything is competitive.
Yeah.
And if you don't have a competitive cost base, you're not going to win. Yeah. And so the companies are doing everything to be competitive. And the biggest driver of competitiveness is scale. If you look back, I like the example of offshore wind, because the first offshore wind farm in the world was built in 1991, and it was a 5 megawatt wind farm. And today the turbines going in are going to be 10 or 12 megawatts very shortly, and there might be 100 or 200 of them in a single wind farm. So the scale is enormously bigger, and of course the developer might have half a dozen projects like that in their pipeline. Solar parks can be 1 million or 2 million panels at a time, or even some we've seen that are even larger than that. And you get a totally different price on solar panels when you're buying them 1 million at a time, or maybe 10 million at a time if you're ordering for a whole pipeline of projects. So size is very important here. Size also helps the cost of capital, which I talked about just now. And so I think it entirely makes sense for the green majors to go after scale. And that is what they've been doing in the last year or two.
And I suppose that scale seems to be mainly in the development than the operation of the assets. Is that right? And so arguably once these things are built, the natural owner may be someone different.
Well, that's right. And then you get into the sort of financial engineering of it, because of course, if you're going to sell it to there's still scale in operations. So if you're going to sell a stake to someone, you're probably going to keep operating the asset for them. And then they want to know that you've still got skin in the game. So there's an argument whether that means you need to have a 25% stake or a 50% stake. But mostly the big developers are keeping significant stakes in the assets they build. And of course, it's the income coming in steadily from those projects which supports the balance sheet and keeps the cost of financing the next project low. If you took that idea of yours to the extreme where you just sell everything after you've built it, you would have a different earnings profile as a developer. You might have a very good year with lots of projects, and then you might have a year with no projects, and your credit ratings and cost of debt and equity would have to reflect that. So mostly what we've seen them do is go for this kind of hybrid model where you can recycle capital out of one project into the next one, but while you continue to own a significant stake in that project.
Interesting. Great. So I'd like to conclude with a few underrated or overrated questions, just to see where you stand on a couple of what I think are the central issues in the electricity system over the coming decade or so. So I'm going to give you a concept, and if you tell me whether it's overrated or underrated, and then I might ask you if you can elaborate a bit. So the first concept is markets for electricity. So do you think markets for electricity are overrated or underrated?
I think overrated.
Interesting. I think you're probably the first person on this podcast that's ever said markets for electricity are overrated. Can you, in fact, can I ask one follow-up question on this? I suppose, would you call an auction for a CFD a market?
I see. Right. Okay. So tendering to get the cost down. Maybe that's been very important. I was interpreting you more to mean, the merchant market.
Yeah.
So people building power stations and bidding in at a competitive price to sell the next megawatt hour. Or
okay. The sort of merit order dispatch type.
Yeah, and my feeling is there was a one-time gain when the world went to
privatized
merchant markets.
Yeah.
Because there was a price discovery. You found out over a period of years what it really costs to run an efficient gas or coal-fired power station or efficient nuclear power station, etc. But that discovery has been discovered. So now we know. And actually, I suspect what we'll see over the next 10, 20 years is a gradual re-regulation of electricity markets with more and more central coordination, central buyers, central dispatch models, etc., where the regulator maybe auctions the right to be in the market over a 10-year period, but then just tells you when to dispatch or not, and it's your job to follow your instructions rather than make a commercial decision about when to fire.
Yeah, one interpretation of history is, these things were great for, we had these public utilities that tended to overbuild and markets were great for sweating assets hard and telling people to shut down. But that was a sort of one-shot game. And I think we are rethinking what markets are useful at the moment. Okay, the second question is flexible demand as a solution to security of supply and grid stability. And just for listeners, by that, the idea, much is written about the idea of, Tesco turning down the fridges in their supermarkets, or electric vehicles responding to grid frequency in real time. And can that solve some of our problems? So, Sam, do you think flexible demand as a solution to security of supply and grid stability is over or underrated?
No, I think that's a bit overrated too, I have to say.
Okay.
That's probably less controversial than my answer to the last one. But
yeah. Okay. Good. Well, I won't dig into that one, but we could, and it would be interesting. The final one, and this relates to that hydrogen topic. The role of electricity in decarbonising the global economy. So, do you think if we have to get rid of all of our fossil fuels, do you think electricity, the role of it is overrated or underrated?
No, I think it's underrated. I think there's often a sort of a line of thought that says, we just need to switch out the coal and gas in the power system for wind and solar, and then sort of electricity is finished. But obviously that only gets you to clean energy in the power sector, which is something like 40% of energy emissions globally, and we need a solution for the other 60% of emissions. Now, there are various kind of ideas out there, but one that you mentioned obviously is hydrogen. And if we're going to serve the sort of decentral buildings, transport and industry demand centers with hydrogen, where's the hydrogen going to come from? It's going to have to be made with clean electricity. So, my view is either we're going to electrify the economy, or we're going to put the economy onto hydrogen that's made with clean electricity. But clean electricity is the underlying solution on both sides.
Interesting. And so what percentage of, very broadly speaking, let's say, fast forward to 2070, world's close to net zero, hopefully. What percentage of our energy is coming from electricity as a primary source, whether it's hydrogen or something else, do you think? Is it greater than 90%?
If we get to 90% in 2070, we'll be 20 years too late for net zero, but I think we'll be doing better than expected right now.
Okay, but you think...
I avoided giving you a number.
Yeah,
but I did that
I'm trying to work that one out.
my view, and this is maybe a good place to land at the end of this discussion, which has been super interesting. So thank you, John, for your questions. But I think we have to be a bit careful in our sector, because there's so much happening and it's so exciting. We've got these incredible cost curves on wind and solar. We've got a cost curve on storage, maybe one on hydrogen that's coming. We might have new forms of nuclear that are small and flexible and solve the problem of big nuclear projects. We might have demand response and some of the other things you talked about. We've got lots of policy support. All these things are coming and they're exciting. But every time we've tried to add up the sum total of all these good things and put it into a model that gets us to net zero, we struggle. The challenge of net zero is unbelievably huge. It's essentially the challenge of replacing that 100 million barrels a day oil market that we've built in the world completely. And I don't mean to be pessimistic, but I think it's very, very close to impossible to do that by 2050. Maybe we can do it by 2100, or maybe we can get lucky somehow and do it by 2050 after all. But I think it's increasingly difficult to see net zero 2050 as a base case. It's the wildly optimistic upside case.
Yeah.
And that means that we not only have to have all of these conversations and so on that we're having now, but we also need a conversation about what needs to change in a world that is hotter, where we've gone over 1.5 degrees and the weather is changing, and we need adaptation as well as all this good stuff we've been talking about on mitigation.
Yeah. I think that is a great note to finish it on, Sam. So to summarize, it's hugely exciting. It's obviously very challenging. And I was delighted to hear you think electricity will have a very large role to play in it. So I've also made a note that if we ever want to do a podcast on the problems with capitalism, that you should be the special guest. So we may well take you up on that at some point. But I think that's a great note to conclude on. So Sam Arie, research analyst at UBS, thanks so much for joining me.
Thank you, John. It was a pleasure.
That was Aurora's co-founder and chief executive, John Feddersen, speaking to Sam Arie, research analyst at UBS. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening and goodbye.